Welcome back to Not Financial Advice. This is Sean, and on today's video, we're going to be talking about the top 3 ETFs to hold for 2024 and beyond right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. By the time you read about it in the Wall Street Journal, it's already too late.
And if you're new to the channel, what we do here is show you 100% of my holdings, not only on green days, but also on red days as well. And additionally, what we do is take requests for reviews on stocks or ETFs. So if any of you have a stock that you'd like for me to take a look at, or an ETF, just drop its ticker symbol in the comment below, and I'd be happy to make that video for you. Now, to get started, what we're going to do is briefly review my portfolio and see how I'm doing today in contrast to the market. And so the market is down 0.1%. I'm up 0.1%. And so it's been a pretty volatile day. What's moving the market today, high level, was the announcement of spot Bitcoin ETFs, which have started trading live as of this morning. But additionally, we had a little bit of a hot CPI print. We're going to talk about that in just a second. But those are some of the things that can be moving the market and may be moving the market right now. But as always, because I have a pretty diversified portfolio, we can usually get a pretty good handle on what's going on just by looking at my top 5 gainers and decliners of the day. And so here they are. My best performing stock today is Curaleaf Holdings, up 4.4%. Netflix is up 3%. Salesforce is up 2.75%. Up 2.75% is Green Thumb Industries, and up 1.9% is Estee Lauder. The ones doing the worst are going to be Paramount, down 5.9%. Down 5.5% is Coinbase. Down 3% is Tesla. Foot Locker is down 2.5%. And Walgreens is down 2.2% as well. And so, as I mentioned to you, we had a little bit of a hot CPI print. And basically, economists were projecting that inflation would increase 0.2% month on month. Now, this is looking back to December. That reading came in at 0.3%, so it was higher. Economists and analysts also expected that we'd have an annual growth of inflation at 3.2%, but it was 3.4%. And so that, along with the spot Bitcoin ETF announcement, those are the things that are sort of shaping this market today. But as I said in the introduction to this video, what we're going to be doing is covering the top 3 ETFs to hold in a portfolio for 2024 and beyond. And so we're going to do kind of a countdown and start with number 3, which is Vanguard's VBR, or small cap value. Now, this one has done pretty well overall time, as you can see, but it's been essentially flat for the last 4 years. While these companies have been producing more revenue, more free cash flow, and more earnings per share. So let's take a look over on Vanguard's website and see what we might find attractive about this investment. So right off the bat, it has a market-beating dividend yield of 2.1% and a pretty low expense ratio at 0.7%. And so it's in the name of the ETF, small cap value. But what is this fund really? So this ETF, it holds 835 stocks, as you can see here. But its average or median market cap rather is 5.6 billion, which means that this is more of a mid-end small cap value ETF. It has a low PE ratio of 11.5. And let's take a look at some of the top holdings in VBR after we look at the sectors. And so in VBR, your biggest sector is going to be industrials at 24%. And then financials is at 21%, with consumer discretionary at 15.8% and real estate at 8.5%. And so that's an allocation to industries that's quite a bit different than the S&P 500. But when we look at the top holdings in VBR, You have Booz Allen Hamilton. I think they're a defense contractor. You have Jabil, which I believe is like a mid cap technology stock, if I'm not confused. Let's look at the next couple of pages and we'll stop just once we stop recognizing things. To be honest, here on this second page, there wasn't anything that I necessarily recognized or stood out to me. But on pages 3 and so on, there are some other companies that give you a better sense of what this ETF is all about. And so you have Williams Sonoma here. This is more so of a mid cap value stock. I own quite a bit of it. Um, Going to page 4, let's see if we recognize any other companies for VBR. So Huntington Ingalls, I think that's aerospace and defense. And then you have Toll Brothers, a home builder. Let's look at page 5 real quick. Page 5 has some stocks on it. What are they? Cleveland Cliffs. I think they're a materials company, but then you also have BJ's Wholesale Club, which is a grocery store. Robert Half, that I think is in transportation, if I'm not mistaken, and then so on and so forth. So, that's sort of that overview of VBR. What we're going to do now is move on to number 2, which is SCHD, a very famous ETF. As you can see here, it's kind of a similar chart to that small cap value. This is a large cap value ETF, and it's just sort of been flat for 4 years, which would signify to people who look at charts that it's about to make a move higher or lower. And so let's take a look inside of SCHD and see what we can find. So here at SCHD, it has a low expense ratio of 0.6%. And instead of reading this to you, I'm just going to let you know basically what this deal is about. So SCHD takes a whole universe of bigger stocks, and then they rate them on 4 criteria. So starting dividend yield, dividend increases, and these have to be steady dividends paid for at least 10 years. Then they look at low debt and high returns on equity. And so it's actually a pretty smart, passively managed construct for an ETF, which has produced some pretty good results over time. So, what we can see looking at this is they have a PE ratio on this ETF, an average of 15.1, which is quite a bit lower than the S&P 500. Passively managed large value, and a dividend yield of 3.54%, which is like 2.5 times bigger than the S&P. So let's take a look firstly at the sector allocation. So 18% industrial, 17% financial, 15% uh, financial. It was rather 17% for healthcare, 13% for consumer staples, and then information technology at 11.7, energy at 10%. And so if you just take a second and look at these industrial, healthcare, financials, these are some sectors that didn't do very good in 2023. And oftentimes the market, rotates and trades leadership off from sectors to size to style. So definitely a reason for me to be excited about my holdings in this ETF this year and moving forward. But its top holdings are all going to be ones you pretty much recognize. AbbVie and Merck are medical companies. Broadcom is a chip maker. You have Home Depot, of course. Amgen is another healthcare stock. Texas Instruments is a chip maker. Then you have Cisco Systems, Verizon, Coca-Cola, Chevron. Let's take a look at the next 10 or 20 so holdings. Last one we looked at was Chevron. So let's start there. I'm going to ask you to like the video and subscribe to the channel, please. Sure appreciate it. We also have Pepsi, then Pfizer, UPS, BlackRock. One of the issuers of the new crypto ETFs this morning, by the way, Lockheed Martin, ADP, Blackstone, Altria, so on and so forth. Some other names that are recognizable are names like 3M and Allstate. So those are the stocks held within this ETF. There's about 105 holdings in this ETF. So pretty concentrated. But now we should be excited because we are on to our top ETF to hold in 2024 and beyond, Vanguard's VTI, or Total US Stock Market. So you can see here is really good performance over all time. But in the last 5 years, there was a lot more ups and downs, which means if you're dollar cost averaging in here, 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 and here, you probably had a stronger return. Um, but yeah, that's VTI. And so what is VTI? To understand VTI, you have to understand what the S&P 500 is. Its most popular ticker symbol is VOO or SPY. But the S&P 500 is America's top 500 most popular companies, most successful companies in the stock market. And so the best way to understand VTI is to first understand the S&P 500 or VOO. So I just want to draw your attention to these top two holdings to make it super simple. So Microsoft in the S&P is 7.3% and Apple is 7.2. Let's go over to VTI, and we're going to skip around a little bit, but notice that in VTI that the holdings for Appersoft, Michael and Appersoft, sheesh, Apple and Microsoft are both about 10% less. Now, why is that? The VOO or S&P 500 holds about 500 stocks, whereas VTI, or the US Total Stock Market Index, it actually holds every stock publicly traded within the United States. So instead of having 500 stocks, it has 3,800. And so it's those top 500, but then all of the mid cap and small cap stocks under that. And so it has a PE ratio of 21.8, whereas the S&P 500 currently has a PE ratio of 23. And so looking at VTI, there's a little bit lower of a dividend yield than the S&P 500, 1.4% as opposed to 1.45% on VOO. But then again, on VTI, you also have a pretty low expense ratio. It's probably similar to VOO. So 0.3%, really low expense ratio. So this is just every stock in America rated by popularity. That's what VTI is. I'll ask you to like the video and subscribe to the channel. Now we're going to move fast here. What I want to show you is a back test I did on Vanguard Small Cap Value, VBR, SCHD, and VTI. I was able to back test them to 2012. And what I found when I did that wasn't unsurprising. Uh, the the sector or the stock or the ETF that did the best was in fact the S&P 500, very hard to beat. Everything else did worse. Now, even though S&P 500 has 500 stocks and VTI has 3,800 stocks, you can see how they're here within like 0.2%. And that's actually pretty common. In longer periods of time, the bottom 20% of VTI, it all sort of comes together and it tracks S&P 500 pretty closely, at least in recent times. So SCHD did a good amount worse than VOO here. VOO did 13.8, SCHD was 12.7, and then VBR was only 11.4. So then the question might be, why would I want to own anything other than the S&P 500? And so that's what I'm going to show you next. So we're going to look back to a back test I did from 1977 to 1987. And so we were getting out of the Vietnam War. Interest rates were high. There was a gasoline shortage. There were a lot of, back and forth changing of power within the government. I believe from Carter to Reagan, geopolitical stuff, same sort of stuff that we have going on today, but a little bit different. History doesn't repeat itself, but it does rhyme. And so the question is, in our investing lifetimes, will there be a series of events that replicates this decade? Maybe. And so let's see how these different asset classes perform. So obviously SEHD didn't exist in 1977. What I've done, and it'll be the same for the next two back tests after that, I've looked back to 1977 and I've For VBR, I've put in the asset class US small cap value because that's basically what that is. For SCHD, I've put in the asset class US large cap value, pretty close to SCHD. And then for VTI, the total US stock market, I've of course inputted US stock market. That should be 1-for-1. So looking back from the years from 1977 to 1987, this is where things start to get interesting. And so in that decade, the S&P 500 returned a respectable 12.5%, but this is where things get interesting. So the total US market returned 13.1%. That's more, especially over a whole decade with compound interest. But then look at this. Large cap value returned 15.1%. Again, the S&P 500 only returned 12.5. This is returning 15.1. But then small cap value did 21.7% in this decade. That's a reason to pay attention to some of these different ETFs. Now, I've done the same test, but this time from 87 to 97. We had a recession in 1990, 91 around the Gulf War. And then we were coming into sort of an overheated market in 97. Let's see how these other three portfolios performed against the S&P 500. So from 87 to 97, what you can see here is that the S&P 500 returned a respectable 16.6%. And then you had the total US market lag, only 15.7. But neck and neck with the S&P 500 was large cap value. But then here you can see about 0.75% higher returns for VBR during this time period. Again, 87 to 97. And, there's also times when you add less volatility and higher dividends. So stuff like that can add up as well. But then looking at 97 to 2007, this is really interesting. So this captured the entirety of the tech crash of 2000, as well as the beginning of the global financial crisis. So this was bookended by two recessions, essentially. And so what you can see here is that in this time period, many of you who are watching this were alive, from 1997 to 2007, the S&P 500 returned a decent 8%, but the total market 8.3, large cap value 8.6, and again, VBR, one of my favorite funds, returned 11.25%, trouncing the S&P 500, which was at just 8%. And so you can see why these different types of strategies can be helpful in having a diversified portfolio under different market conditions. Um, so yeah, when thinking about how to set up a portfolio or how to optimize it, I'll end with this. Like the video and subscribe to the channel if you got value out of this presentation. But I'm over here on ETF Research Center, and so we can see something interesting. So I compared the overlap between VBR, small cap value, and VTI, the total US market. And so because the total US market has every publicly traded stock in America, it contains 100% of the holdings in VBR. And so why would you have both of these funds? So I barbell them. I own a lot of VTI and I own a little bit of VBR. And so why would I do that? So even though there's a 24% overlap in names between the two holdings, what you can see here is there's only a 6% overlap by weighting between VTI and VBR. So that wraps up this video, this series. I hope you really enjoyed it. As always, feel free to leave a stock or an ETF's ticker symbol in the comments below, and I'd be more than happy to make a video reviewing that for you. Until next time, this is Sean, and I'll catch you around.